Hey guys, welcome back to the review of my financial preparation and planning to start my own business. We're going to pick up right where we left off here at the P&L statement for year one. The previous video I gave some explanation of the format of this and the contents of it. Now we're going to delve a little deeper to the actual values and metrics I have in here and how it is that I came up with those in order to plan for my own business. So right up here at the top, the revenue categories, you can see that I have 3 months of zeros and then 9 months of values that are all equal to each other. Now, when I made my projection of the total revenue I believe I could generate, I evaluated the market interest in each one of these services that I'm offering and the time, since that's my unit of sale, right, is my time, how much time it is that I logically believe that I could devote to this along with my other obligations in life, and multiply the two, right? My resale rate and the time I could put into this, that's my revenue generated. But what I have projected in here is the time it's going to take for me to educate the market. Now, market education is something that needs to be understood in case you're in the boat like I am, where you're offering something new, whether you're just a new business or it's a new service or something of that nature. You have to get the word out there to your clientele, your potential customers, that you exist, what your services are, and why it is that they should use and employ you. Now, that doesn't happen overnight. Subsequently, you're not generating sales overnight if you're in that particular condition. So I'm anticipating it's going to take me about 3 months, 90 days, calendar days that is, of cold calling, pounding doors, visiting conferences, doing things that I like to get the word out there. What my business is, the service that we offer, and trying to generate enough interest that's going to culminate hopefully in landing contracts and executing some business that can be conducted there that I can start billing for. So that's just the time period that I've allotted. That's just, I guess, based off my own experience, that what I'm anticipating could be better, could be worse, but I'm anticipating it's going to take about a quarter of the year for me to really generate enough interest that customers will start utilizing that service. But thereafter, I believe that it's going to be steady. Pick up, take off, should be continuous after that fact. I don't have any kind of slow ramp up that's taking place here. So going back to my target customer projections, you'll see these values over here, match the values I have in there for each one of those revenue categories. And just because I anticipate that my workflow is going to be fairly steady and continuous, you're going to hope that it is so. Is how it is that I've targeted those amounts. Now, your business model, again, if you're in retail, right, you have highs and low seasons. There's a lot of different businesses. There's a lot of different markets that do have highs and lows. Even structural steel that I'm in with my current employer, it has highs and has seasonal lows and things of that nature. You're going to want to project that. That's very, very critical that you're realistic and accurate in doing so, because that's going to impact the actual cash that's revenue. The revenue that's generated that goes into your cash flow to sustain your business. So if 90% of your profits are landed in the last 3 months, right? If you're in retail, if the holidays come around and people are buying, and that's really what sustains you, you're going to make sure that you make enough in this amount of time, these 3 months, to cover your business expenses for the next 9 months in the following year and things of the like. But just be aware of the market conditions and what it is you're getting into. It's another reason to be diversified in your revenue streams. Hopefully you'll identify some that kind of offset one another so that you're constantly generating revenue to operate your business at any and all points in time of the year. So that's how I've come up with what it is that I've given some explanation to that. Now, in my first year, my cost of goods sold, again, this is direct costs associated with producing the good or service that you're going to be reselling. Now, in my first year, I don't have any employees. I'm not even paying myself for this. So my only savings really is the time that I'm putting in to produce these services, because that's going to be at no cost to my business. It'll be a cost to my time, but not my business, because I have to start making money to spend money to continue to grow. But I cannot just in and of myself produce enough time to meet the demand of the service that I'm looking to offer. So I'm going to have to outsource a lot of that. So I'm going to be working with my network, my resources in order to provide that with others that are in the industry. And they're going to be charging me. I'm going to be marking that up and passing that cost on to my customer. So my highest profit margin is on time that I'm putting in directly, but I have a lot of cost of goods sold, and none of that is in-house. You'll notice that. So I don't have any employee salaries I'm paying, no workers' comp, no benefits, no payroll tax, none of those things, because I'm not drawing from any of that. But I'm expensing a whole heck of a lot from others that are going to be helping me provide this service to actually start my business and make it sufficient, right? So that's what I have cataloged here, is their time at the rate that they're going to be selling that to me, at the time that I believe I can afford to sell, that I'm going to have to be involved with, is how it is I've come up with those costs. The difference in this, again, is my gross profit margin. They're different in each one of these, and you can see that here. But the total gross profit margin, culmination of my revenues versus cost of goods sold, regardless of the revenue category they're generated from, is demonstrated down here at the bottom. So I'm going to try and put as much time as I can personally into this, because that's where I have my largest return. And the larger returns I have, the more I can start investing in my company to grow, and I don't have to be subjugated to outsourcing all of my time and materials that I'm putting into producing this service. That's ultimately my goal, but I need to feasibly find a way to get there. Now, I do have operating expenses. Just because I don't have an employee and I'm not drawing a salary, I certainly have operating expenses. And I have a hefty startup cost in this, right? I need equipment, I need marketing, I need branding, I need all kinds of different things in order to even get to the marketplace and be able to start my business. And that's shown in this 3 months where I'm not even generating revenue. I would say this condition is the biggest thing that you need to take into account and look out for. Once you start spending money, which could way precede opening your doors. Let's say you need to remodel an existing unit that you're going to be occupying. I mean, if you're a restaurant or something like that, if you need to upfit the location, buy equipment, move that in, just to even bring it to a condition where you can open your business, that's all stuff that you're expensing prior to even being able to make transactions and start making money. It's going to be very integral to your survival and your projections that you figure out not just the cost, but also the timeline, the downtime, right? I have this 90 days here that I'm not going to be doing business, but I'm still expensing a whole heck of a lot to go into business. Now, we've talked about in my prior video what a lot of these expenses are for. Right here, this $5,000, you'll probably recognize that as my website that I need developed here. I have a lot of, let's say, office supplies and utilities and things that I'm going to be needing just to even offer the service that I have. We can go into greater depth as to what that is. You'll notice here in my formula bar, I'm identifying costs from different areas. Well, let's go ahead and even do that just for your sake here. I have under my operating expenditures, I have items rows 9 and 10 and 12 through 14 on my startup cost estimate. So let's look at that. 9 and 10. Acquiring a fictitious business name, startup cost one time. Liability insurance policy for my contractor's license, startup costs one time. And then we're looking at 12 through 14. So we have website domain, not the development. You saw that under the equipment cost, right? There's the $5,000. But hosting the domain to maintain my website, that's in there. Marketing paraphernalia, fees, permits, and licenses, that's all in there as well. So that's what I'm showing there, my startup cost of operating expenditures. Because you'll see I basically don't have any else for the rest of this time. I do have two more. And I already know this one off the top of my head. This is vehicle maintenance for all this traveling I'm going to be doing 2 times for tire rotations, wear and tear on that, oil changes, things of the like. That's also expenses that's going to come out of my bottom line. Here's my website, things of that nature. So you can see all this, right? In my first 3 months, I'm expensing, this is well over $10,000 right here. Just doing that off the top of my head. Well, just barely over $10,000 that you can see right there. Right? So that's going to cost me a fair amount, but it is very important that I accurately capture what this is going to be and how long that's going to be until this turns into a positive number here that I start invoicing. Another thing that needs to be taken into account, and quite seriously so, is just because you've submitted an invoice, right here I'm showing a positive number in my profit line. I'm finally showing revenues here being generated in my April month of my first year. But most invoices on the business model that I'm going to be serving in and with are done on a net 30 term. So that's another thing to consider based on your business model. If you're in retail, if you're in the restaurant industry, if you're in anything where you're actually requiring that the customer pay up front for the service, you have a predetermined cost for what that's going to be for their experience or the good that they're receiving. That's one thing. You're going to be expensing all of your money in inventory and market, research and development to actually produce or develop that product or that experience, whatever it is that you're selling. And then at the point that your customer comes into the equation, you're already transacting that funds and you're collecting on that. Now, mine's a little bit opposite. I'm marketing a service to my clientele that they stand to benefit from, and I'm going to be selling my time. Now, it remains to be seen how much time actually gets induced into providing the service that they're looking for. So I'm going to be billing them at an hourly rate. and I cannot invoice them until I know how much time is incurred into that. And then they receive the invoice. I've expensed the time and the labor for that, right? I've already paid off all of this up here, my cost of goods sold. But it's going to take another 30 days feasibly till I return those funds or have those funds returned to me from the customer via payment. And you need to be aware of that as well, your pay cycles and the offset to that. That's why at the end of the year, I still have an AR balance. I have an accounts receivable balance, and that's basically my last month. I have billed for 9 months. I have collected on 8 of those. I have an outstanding balance for my accounts receivable of that final month, and that will impact you. So you need to be aware of that. And down here, you can see my cash flow and where that starts from my startup cost estimate and the impacts based on the expenses that are incurred, but then the funds that get injected into that, where it starts growing here, right? You can actually see this one start ticking up because it's my first positive number on my cash flow detail. Starts being induced into this, and it grows and grows and grows, and I have a year-end final right there, and that's where we kick off. When you look at my profit and loss statement for year 2, is that same exact balance. It's right there. That's where I'm going to continue on into the following year. I will note that, again, since I am not personally seeking any kind of loan for the financial resources to start this up, there are some information that a bank may request or require of you that's not depicted within this. One of those being your your debt service ratio. They're going to be utilizing that, which is basically what are your loan payments back to the bank and what are your revenues generated, and the ratio, the difference, the disparity between that, right? That's how they're going to dictate the return on their investment in your company. And if that is not happening at a rate that makes them comfortable to give you those funds, they're probably not going to. They need to qualify for themselves that you're making enough money fast enough to pay off that loan in a reasonable amount of time, because they don't want extended terms on a business loan, not for a startup. So that's one thing to take into account. And since I also don't have that, I'm not showing principal payments and I'm not showing interest payments, which actually would be segregated out of your operating expense and your cash flow detail, the impact on those, because that impacts your debt service ratio, which isn't in here. But I do have some old forms when that was part of my equation or my consideration, and future videos I'm going to try and go back to those and give some kind of explanation to what that is, how to calculate them, and what you need to know about them. But this should be sufficient for the time for you to understand what it is that you need to do and prepare properly for your business, its operation, and its several year in doing so. So following into year 2, really the only differences are an increase in my market share, which is only afforded by an increase in my resources, which is costing me, right? At this point, I'm hoping to have employees. So I have more in-house services I have to offer. It's more time that I have to sell to the market, which is more revenue I can generate, but my expenses are now incurred in a different form. You can see I'm hoping to do all of my takeoff and development in-house. I'm not outsourcing that anymore. I have that employee in-house, but now I'm paying that employee and his workers' comp and his benefits. I'm paying payroll tax on processing that and everything else in between. You can see how that's segregated here. So I already know what it is about the market value of somebody capable of providing that service at an hourly rate and employed full-time, minus paid holidays, and an efficiency factor that I've determined is what I have of time that I can induce as sellable revenue generated, but cost of goods sold, I'm paying for full-time employment all throughout. And it's important that you capture this because I need to be able to prove that I can sustain that payment, right? Since now I have an entirely different association to actually producing that good. You can see the impact on that on my gross profit margin. Since I'm doing things in-house and I'm not incurring the markup of an outsourced provider of that service, I am generating more money. That's good. And I'm also still actively involved myself without receiving payment of producing the time that I'm going to be selling, so that's only increasing my profit. And I'm doing so that I can make enough money to continue to grow my business. Because you saw throughout the entirety of the last year, I only made just over $15,000. Well, actually, that's not even true. If you consider the fact that I took $20,000 infusion to start the business, I had a total net loss of my starting capital of almost $5,000. So I need to continue to make money to return my initial investment into this and continue off into the future in investing in my business and growing my business and improving my business to stay viable and alive in this industry. And that brings up a very interesting point that we should look at next. And maybe some of you have heard of the term break even. You may want to evaluate for yourself, what is your break even point? And so talking about that, I had a $20,000 cash injection startup cost. And so at what point do I recoup that $20,000? It's not when I hit $20,000 in total profit, but in my cash flow. And that occurs right here at this point. So that is at the fourth month. This is April of my second year that I hit that just slightly over $20,000. And that's why I have a full return on my capital investment to start this business. So everything after that would be a profit, a net profit to my actual cash injection. So at the end of 2 years, I should net, let's say $46,000, 213, right? That's what we're looking at there. So if I were to, say, reach this point financially and then cut ties, I had nothing lost and only gained in experience. I at least made my money back on that. But you can see here, even at my projections, it takes 16 months of that, 12 months of generating revenue, and 3 of those months with an additional employee, and hopefully the revenue generated for the addition to that staff and my resources to produce and sell. So some of the things that you do need to know that does take place here on the second year P&L that has an impact that you didn't see there on the first is now my salaries are shown differently there as an expense, right? It changed my direct cost of goods sold up here, and then I have 0, at least in this revenue category, but I'm expensing it via in-house employment on that. But it has its own category down here in my gross profit margin consideration. Now, it doesn't change this calculation at all, right? It still is showing the difference in my revenues versus my direct cost of goods sold, which is all outsourced material, but now it's also deducting the labor amount that's in that to give me my gross profit margin amount. Some things that you may notice is that I have yet again another more substantial, at least in comparison to the rest of the year, startup costs in the first year, and that's because I'm buying equipment and things of that like, more software, everything that's necessary in order to now have employees, things that I was not previously yet concerned with. And that is an example of the investment that you need to make and plan for future growth into your business, right? Year 1, I had no employees. Now, in order to continue to grow and develop my business, I have to acquire employees, which cost me money. So I have to basically prove in the first year that I've made enough money in order to make the leap, the investment into having employees, and then I have to show the return on that investment by increased revenue generated and increased profit margins in order to really substantiate that move and qualify the means of having more employees. And so you'll notice that not much more is different from that. And year 3 just continues in that trend, and the information is provided within that. You can see that my salary cost has gone up substantially from years 2 to 3. Right? Less than $5,000 a month just in sheer salary. And in year 3, wow, over $17,000, right? So what's the difference here that's taking place? A few different things. In year 3, in order to continue my growth trend and in line with market interest that I believe will be resonant at the time, I need yet more employees in order to produce more man hours that I can sell to increase my revenues and total net profit amount, not necessarily gross profit margin percentage. You'll notice the difference there. But by year 3, I'm hoping to make enough money to finally start paying myself, right? Woohoo. Big. That's something of a milestone. With this gross amount, when I'm finally generating here, and in all of these categories, what it's going to cost me to produce enough to be able to sell this amount, assuming that I can do so and the market and interest is there, I am now making enough money that I can start paying myself. And that's going to be probably the biggest impact you see to my gross profit margin percentage that's taking place there. I am now no longer doing this for free. And that is a milestone that you're going to want to identify for yourself if you're even relatively in the same boat of having financial constraints for your startup that I'm looking at here. I will note this because maybe you're not aware. I don't know that you are or not, but you do pay taxes specifically on payroll processing. You need to be aware of that as well. And that's going to be taken out at each time that you do process that. So if you have employees, much like anything else that you do, you're going to be taxed. Under all the rest of this, actually maintaining and doing your financial statements once you're in business to encapsulate how much money it is that you're making, because you're going to be taxed on your gross revenue amount. You're going to be taxed on your net profit margin amount. You're going to be taxed on everything. So there's use and sales tax on your equipment and materials that are utilized into operating your business. There is a tax on everything that you need to identify. But most of this, your tax is dictated based on your performance, so you're not taxed until after the fact. Well, you're going to be taxed before the fact, I'll actually completely rephrase that. You're going to be taxed in advance based on your projections. And then whether you actually did more or less business, then you get an adjustment from your taxes. You either get money back or you get charged more. Absolutely no different than filing your own taxes, your personal taxes, where you can either receive more money if you overpaid or you have to pay more money if you underpaid. Your business is scrutinized in the exact same way by old Uncle Sam in your wallet book. Okay, I have yet again some more equipment purchases, now substantially greater, and things that associate with that going into year 3 because I have more employees now. But another difference that you're going to notice, right? We're talking about the disparity still from your gross profit margin to what it is I actually make and get to take home at the end of the day. You'll notice I now have rent costs and utilities. I am now at year 3 with the number of employees that I have, anticipating the need to occupy space, which means I have to pay rent on a monthly basis, and I'm going to have to pay power, I'm going to have to pay water, I'm going to have to pay sewer, all of those different kinds of things on a monthly basis. And I'm encapsulating those costs down here in my operating expenses. It would be a relatively small office space that I need. I know what approximately per square foot I would need to utilize and what that's going for in my local area, and I've determined the cost of about $1,500 a month in order to do that, with utility costs reaching up to $500. With that, I'm also projecting that I'm going to be utilizing a lot more office equipment like paper, sticky notes, pens, whatever it is that may be, and that's shown up there. And I'm going to highly recommend that you take a hard look at determining what it is that you're going to need on a daily basis to operate your business. The small things, I mean, even that's just like receipt printer paper, right? Licensing fees, things of that nature, just reoccurring expenses that you really take a long and hard consideration to try and determine what those expenses are going to be for you. So now you'll notice that in spite of those investments, my profit margin went down a little bit, but I'm paying myself substantially more, and that translates to a lot more difference than just my profit margin. My net profit as well is quite seriously impacted by that. And with having property rent, utilities and other things of that nature for travel expenses and my operating expenditures, there's some fluctuations within this now, so that sort of has more of a regular month-to-month impact and basis on what my actual net profit margins are. And you can see over the entire course of that year, even with my increased market share, my higher revenues, that my beginning and end cash balance starting from the end of the year, end of last year was $66,250. I've made less than 15, right? Actually, I've made less than 10 right here. You can see what the increase of that is, and it's substantially lower. But I've made a pretty hefty investment in year 3, particularly in myself, but I recognize what that is, and I was really working in years 1 and 2 to get to a point to where I can finally personally start having some kind of return on what this has been. So now I'm drawing an additional salary on top of it and supplement to the employment that I'm already sustaining. I have a roughly $55,000 return on my initial cash investment of $20,000 to start this business, and that's important to identify. So this has been an overview of my content and information of the first 3-year projections via profit and loss statement form for preparation and planning for my business. As always, if you should have any questions or comments regarding how it is that I've gotten here or the format or these particular documents and how they're utilized, I would very strongly encourage that you do please add that to the posting of this video. As always, please do subscribe to my channel and let me know what it is that you're enjoying, what it is you'd like to see, and what it is your hopes and aspirations are for yourself. I would love to hear what that is. Please stay tuned as we continue on through my financial planning of starting my own business, and I hope to see you then.